Hi, everyone, and welcome to the Center for International Development Friday Speaker Series. I'm Yomna Mohiuddin, an MPID student here at the Kennedy School, and today's discussion on key issues in renewing the development finance architecture with a focus on sub-Saharan Africa. The format for today's discussion is a 30 minutes presentation followed by a 20 minutes Q&A section. Before we get started, I would like to mention a few housekeeping items. So first, please make sure you check in using the QR code here and on the tables over there. Given that this is a hybrid event, we will be asking questions from both the in-person attendees and the people joining us virtually over Zoom. I will be walking around with a mic for people who want to ask questions in attendance, and Claire will be asking questions on behalf of people over Zoom. We're also recording today's session, but we'll keep the camera on the person speaking to make sure that only people here are recorded. Today's discussion will be posted later on the CID YouTube channel. Finally, our next speaker series is on Friday, March 3rd at 12 p.m., but in the Belfair 500 Bell Hall. The event will feature Valeria Sagiomo, lecturer in international cooperation for development at the University of Naples and a CID visiting scholar, who will discuss why do some development projects fail and others succeed, and the importance of sentiment in aid effectiveness. We hope to see you all there. Please make sure to subscribe to the CID newsletter to get updates on our weekly events and opportunities. Without further ado, I would like to briefly introduce our speaker for today. Ishac Diwan is the Director for Research for the Finance for Development Lab, a new research institute located at the Paris School of Economics, where he also teaches economics there. In recent years, Ishac has also taught at Columbia University, and he taught here at the Harvard Kennedy School. Ishac received his PhD in economics from the University of California at Berkeley. In 1987, he joined the World Bank Research Complex, where he later on became the country director for East Africa and then for West Africa from 2007 to 2011. Finally, Diwan is a frequent consultant with governments and international organizations working on policy issues. He also directs the Political Economy Program for the Economic Research Forum, an association for social scientists in the Middle East. Again, thank you all for being here, and Ishac, over to you.
Thank you, Yumna. Thank you. Good to be with you and with the people online. I hope your sandwiches are as good as, or I hope that my talk will be as good as your sandwiches, that I'll be inspired. Because I want to talk about lots of things, and I don't know how I'll manage to jam them in half an hour. A tour d'horizon, basically, of the finance for development fields. And I thought of doing a tour d'horizon rather than focusing on one issue for a couple of reasons. One is that we have this Finance for Development Lab, an institute that we set up with some friends at the Paris School of Economics recently. So it'll give you a bit the sense of what we do. And Yumna was a summer intern with us. Maybe others will be interested. So this will give you a broad sense. I must say it's also a place that is very influenced by the HKS. It was co-founded by someone from the HKS. Hamouda Shakir, the managing director, is from the MPID program. We're funded by people at Gates that are from HKS as well. So it feels like I'm being employed by, your predecessors here. And so, the Tour d'Horizon also, because while there is a sense of depression, I would say, among developing countries, that the agenda for development has fallen way down on the global agenda because of other things, geopolitical polarization between China and the US, or in Ukraine, other concerns. At the same time, or starting a few months ago, various ideas have started to bubble up. So, maybe things are starting to happen, and you may want to get involved with some of the new initiatives. So that's the tour d'horizon. So I thought I'll start with some numbers, since I like numbers, maybe some of you do, to give you a feel for capital flows. So we're focusing on the architecture for financial support for development, right? So some figures on capital flows and how they've been changing in the recent past, changing slowly and then suddenly. Suddenly, we're after a series of negative shocks from COVID on, we're in a very bad spot. I'll focus on sub-Saharan Africa, but we'll look at other regions if you like. Then in the second part, I'll look at this emerging architecture, in particular, issues around emergency funding, issues around multilateral development bank reforms. You may have been reading about stuff at the World Bank recently. Then debt issues. You may have heard about this common framework that the G20 has created that's not working very well, and the issue of China there. And finally, the new funds that are proposed to deal with climate change and global warming. So here are some numbers. We can focus on sub-Saharan Africa. So 79 billion a year, that's an average for the past few years, is how much capital flows to sub-Saharan Africa. You see next to it is the LICs, the least, the low income countries, then the lower middle income countries, then the middle income countries. So you see these flows are divided into foreign direct investment, total grants. How does this work? Okay, it's divided three ways, right? FDI, grants, and debt flows. FDI is a very interesting, right, kind of flows because it invests, brings technology, potentially leads to exports. And you see as we move into richer groups, this number grows up a whole lot. In Africa, in lower income countries, much of Africa is lower income countries, although there are some mix as well now. You get more of the financing from debt flows. Even though it's risky as well, there is sovereign risk, but there is less project risk, less involvement with local courts and the like. Now, this is the debt flows, this is the net debt flow, net after repayment of capital. So it's the new flows, if you like. And you see the number for grants is quite important, although $29 billion, huge. This is because most of the donors from the Western world, if you want, have moved from loans to grants after the HIPC debt reduction. And so, as we'll see, among bilaterals, China is very large because others have moved to grants, actually. So that's a broad sense. Worker remittances, by the way, are 50 billion around, so very large relative to these numbers. And the GDP of sub-Saharan Africa is around 2 trillion. So the inflow, what's that? It's about 4% of GDP. That's the kind of current account deficit that these countries could afford, and that's the support for development, if you like. So that's the big, that's the big number we talk about. Everything else we talk about is small, is details of that. Of course, one could put this in perspective. When we're talking about climate change and the COP, we're talking of moving from billions to trillions. So we're very far from the trillions at this stage. These are figures for debts, $450 billion for sub-Saharan Africa at the end of 2020. And it's good to look at debts because it gives us a sense of the past, that accumulate over time. So what do we see? Multilaterals, 32%. Bilaterals, except China, 10%. So this is kind of the traditional supporters of development. Multilaterals, World Bank, IMF, African Development Bank, about 40% of the field. Now, if we went back, say 20 years, there would be 80, 90% of the field. What has changed is they reduced their debt with the HIPC process, the highly indebted something countries, which started in the 2000s, And they were replaced. So these countries suddenly didn't have debt. It was a moment where the international capital markets was flush with liquidity, so they could borrow, and they did borrow. And so you see the private debt is 40% of the total, leaving China out. These are mostly banks and Eurobonds. So Ghana has Eurobonds, Kenya, and many other countries. And then China. So China came in early in the 2000s and rose fast with its roads, what's it called? Right, initiative. And by 2010, it was dispersing more or less as much as the World Bank every year. But a couple of years ago, it slows down. It's now about half this much. But it has 17% of total debt, Sub-Saharan Africa. So this is not the kind of debt imperialism, debt trap that people talk around. It may be higher than that. This is official debt. There's some debt to state-owned enterprises. It could be a little more than that. The specificity of China is that it's the largest among the bilateral donors now. You see, all other bilaterals together are 10%. And so, in terms of debt restructuring, to the extent that bilaterals negotiate first and then private after, it has a lot of influence. And market access has been largely lost in recent year. As you know, with stagflation, inflation, tighter monetary policy, credit moves very quickly to higher quality credits and started abandoning these markets. What you have here are the interest rates, or the yields rather, on their euro bonds. And the kind of rule of thumb is when your yield is above 10%, you can't borrow from the market anymore. And we see that for most countries, except, say, we see still Morocco has access, South Africa has access, a few others, but most other countries have been cut off. That's the nature of these markets. They borrow at pretty high rates, 7-8%, when global interest rates were close to zero, and they're cut off very quickly when there's a rush to quality. And the problem, which is new, which we didn't have in the past, is that they have bonds outstanding. So they have repayments coming due, which they would in the past refinance with new issues, which they cannot do if they don't have access to the market. So that's a big risk that's facing us now. Now, this is the total debt to GDP of Sub-Saharan Africa. See, it went down with HIPC, went down over time because HIPC give debt reduction on a flow basis. When money is due, it's erased. And it started to rise again in 2012 or so. Now it's at about 60% of GDP, but half of it is internal, half of it is external. So the external debt is like 30% of GDP. It's not what you would characterize as catastrophically high levels. So we hear a lot about the debt tsunami of debt crisis coming, and it has to do with the fact that we can't roll over these maturities in the Eurobond, but the debt stocks are not very high. Certainly, nothing to do with when the HIPC initiative started, we're over 100%, and moreover, half of it is internal, which is also different. Say Egypt, most of the debt is internal. So internal debt has very different dynamics than external debt. But still, even though we're not at very high level, this is a new type of situation because creditors are very heterogeneous. Yeah. What is external debt? It's debt borrowed outside the country, so with a legal structure that's not domestic. So London law, US law from foreign bondholders. And so when you're not repaying, it involves different type of negotiations where the IMF gets involved also. So I'll talk a little bit more about that. So you see, this is the specificity of the moment. The yellow line measures the degree of concessionality of external debt. And you see, debt used to be highly concessional, and now it's less and less concessional. It's less and less from IDA and the World Bank, and more from the market at high rates. And indeed, the bottom lines are the interest payments as a share of the interest payments. And the other line is the maturity. So the maturities are shorter and the interest cost is higher, right? So you have to refinance that more often at higher rates, and you depend on market conditions. And so this is why we are in a tough situation. Now, sorry for all these numbers, but maybe some of you like numbers. These are net transfers, and maybe these are the last numbers I'll show you. Net transfers are net flows minus debt service, minus interest service. So it's really the money how much money moves to the country on account of debts. Look at sub-Saharan Africa. What I want to show you here is that we're starting to see a gaming between creditors, where they're all trying to get themselves out. And other creditors are afraid to put money in the countries, fearing that it will be repaid to another creditor. So we're getting into these self-destructive debt games that are connected to the fact that there is a heterogeneity of lenders here, private, China, bilateral, Western, that are not used to working together, basically, and don't trust each other. So they're at least the two first groups are trying to extricate themselves, and the last group is afraid of bailing them out. And as a result, everybody's putting less money, and we are falling into a debt trap. And that's really the heart of the situation. So if you see first line, net flows to Africa, you would think that during COVID 2020, they would rise. Actually, they don't rise. They collapse from 19 billion to 2 billion. They do a little better in 21, but still it's much lower. Now, why? China is pulling out $1 billion, $2 billion a year, while it used to be contributing 5 to 10 billion a year before. Now it's retreating on net. So it's still lending to some countries, but it's receiving more than it's lending. Multilaterals have made a big push with the pandemic. You see 11 billion every year. Usually they were at 5, 6, and still at 8 now. And you see below last line is the IMF. Big push from the IMF, $16 billion in 2020, 30 programs in Africa. Every program is about 3% of GDP, more generous than before. 1.5, 2 times quota, still much lower than loans to Latin America, which can be 5 to 10 times quota. And the IMF is still very much criticized for that. But still, a big surge. The surge is ending in 21 from the IMF as well as the World Bank and the African Development Bank. The bilaterals flat, the private sector withdrawing 11 billion, 3 billion. So like China, the private sector withdrawing, and the next line is the private non-guaranteed debt. It's debt to firms as opposed to governments, again, withdrawing. So we have a general movement of withdrawals, maturities coming due that cannot be refinanced. The consequence of that is basically that governments cut spending on their people, on importing, subsidizing bread, on safety net, on health and education, and it leads to a development crisis. It leads to a development crisis before really leading to a debt crisis, because Minister of Finance, don't like defaulting on foreign debt. They'd rather leave that to their successor if possible. It's easier to cut funding domestically. So we're already in the middle of that development crisis. Food prices are higher, fuel prices are higher. There's less foreign currency coming into the countries. They are devaluing, they're increasing interest rates. There's scarcity of liquidity. They're trying to figure out how to make their next payment. So it's already a very difficult situation. And as I said, these are the interests due in 2024, 25. You see there is a wall. Talk about the wall, and this wall will grow further if interest rates keep increasing. The good news is that we seem to be at the end of maybe of this inflation, and maybe interest rate will not keep increasing. But the more they increase, the more this will become problematic. All right, so this is now part two. How are we doing? Whoops, the time is over. No, all right. So let me run through part two. So basically, we come from a period 1990 with HIPC to 2015, where developing countries and Africa has grown very fast, 4 or 5% a year. There were talk of convergence, of development working. As we saw, they got funded by the markets after HIPC, by China. Commodity prices were doing well. So it's only around 2015, 16 that this growth weakened a little bit. But it was hidden by the fact that lots of money was coming in. So it's like things change for the worse slowly, and then suddenly very fast with COVID and the shocks after. And we suddenly find ourselves very far from this. So we find ourselves really with a growth process that's not working anymore. Commodity prices are not as high. Export did not really rise in Africa as much as was expected, and flows have come down. The impact of global warming, climate change is harder. The drag is now estimated on -1–2% growth, depending on the country, just because of the drag from the climate. There were promises, 100 billion promised for the climate, we still per year, which is still not there. We're only at 70–80 billion. Official development assistance has been flat. And as I said, during COVID, there was a little bit of a boost in aid, but nothing compared to the 10 and 20% expansionary budgets that of GDP that we've seen in the West. It's more 1, 2, 3% that we're talking about. So already a sense of being let down, not having the vaccines, not having enough support during that time, and then this crisis in flows that's happening, pessimism on export. Suddenly we find ourselves somewhere completely different. The international architecture is not working. Development is at the bottom of the agenda. The climate crisis is coming. These countries are not supported, not ready to respond, not ready in terms of adapting, and not ready to help in terms of mitigation as well. And so, the main goal is really how to get a new development pathway, a green growth pathways in the future, and how to finance it. What it isn't about, what it should be about, spreading digitalization, adaptation to climate, clean energy, producing carbon offsets. That would be a comparative advantage in Africa. Clean energy also, because there's lots of sun, and using clean energy to produce stuff that you export, clean products that you export. Now, all this requires a lot of financing. So a lot of discussions now are about this, the medium term. How will we finance adaptation and mitigation to climate change? Not enough focus on the short-term needs, the crisis that's unfolding now, and not enough success, let's say, in dealing with the debt crisis that's impeding this kind of progress. There's also lots of talk about blended finance, blending official with private finance. Capital will save the world. Capital will get invested in clean energy. But in reality, very little of that is happening. It's a big failure, and it's a good topic for you to work on. It's not, we don't really understand why. It's really an understudied theme. In Glasgow, there were promises of trillions of pension fund money that will go to be invested in green energy. But in reality, when you look at the numbers, there's less than $5 billion deals per year in this domain. All right, so this is just to say, lots of promises and hopes, emergency funding. There was this great initiative of, since there wasn't enough public money after COVID, of creating special drawing rights, SDRs, $650 billion to support development. 20 billion of those ended up in Africa. Most of the SDRs, they go according to quota, went to rich countries. They were supposed to reallocate them to development, but central bankers are very conservative people. This is reserve money, meaning shouldn't take any risk. And so a little bit went to the IMF, and that's it. Now, President Macron of France wants to, it was his idea, wants to put that back on the table in the June summit he's organizing. But short of that money, it's not clear where public funds could come from these days. Budgets are very tight everywhere. The other possibility is the World Bank. There was a report that the G20 demanded on capital adequacy framework that came up a few months ago, basically claiming that the World Bank is not leveraging its capital enough, that it could actually double and triple. And the bank put a proposal on the table. It wasn't perceived by Janet Yellen and others to be ambitious enough. President is leaving. Now we have a transition. But nevertheless, the idea is that the World Bank would double or triple, will leverage its capital more. There's a game between how much we leverage and how much more capital it will get. But that's presumably going to be one of the big financiers for the future, maybe to become a green bank. The fear there is that there is more focus on capital and leveraging and borrowing from the market, and therefore less on grants and concessional, on IDA, poorest countries. And indeed, we've already seen the climate push crowding out the SDG, the development agenda, actually. We see more money going into these climate funds and less growth, at least, in the support for SDGs. But nevertheless, here you have the initiatives that have bubbled recently. There's an initiative called the Bridgetown Agenda, with an amazingly passionate leader, Mia Motley. If you haven't heard her speeches, you have to. She makes amazing speeches in the name of the Global South. Now, I think I will stop soon, so I will not go over all my slides, but we could share them with you. But I have one slide that compares the Bridgetown Agenda to Africa needs. And basically, the Bridgetown Agenda, Mia Motley's agenda, has three parts. It's all focused on climate, and it's number one, big money for adaptation, and this is the MDB agenda. The World Bank will grow to finance adaptation, a trillion altogether. So the muscle of the World Bank will increase by $1 trillion. Number two, more money going to mitigation. This is capital saving the world. This is the blended finance that's not working. The proposal, the Bridgetown proposal, is to put 500 billion SDRs in a fund that will leverage 10 times more private capital. So they're dreaming, but this is for you to fix. This is over the next 30 years, right? And the third part of this agenda that's interesting is what was negotiated in Sharm el-Sheikh, which is the loss and damage fund. So for the first time, the rich countries have accepted that it's their responsibility to deal with catastrophes because they have emitted and not the poor countries. So a fund exists, but it has $60 million only. There are interesting calculation of how much the rich owes the poor. The African Development Bank has some estimates. For example, they estimate that every American citizen owes every African citizen something like $50,000 a year between now and 2050, priced at I think, $50 per ton of carbon. This is what was emitted, and what we need to go to net zero. What else? I told you Miyamoto, the G20, the IMF has a roundtable coming on debt. So we're stuck on debt negotiations because basically the Chinese don't see eye to eye with the old system was led by the Paris Club. And so the G20 created this broader framework, broader tent, where everybody, including non-Paris Club lenders, would meet, but no rules. And the rules were negotiated on a case by case. So the first country that was treated was Zambia. It took 2 years, and it's not resolved yet. And you can't really resolve all the difficulties between China and the West, and within China, all the Chinese institutions that land, by negotiating on a country. You need to really elevate this discussion on the rules. And this is what the IMF is trying to do now in this roundtable that's organizing in a week or two, actually, 27th of February, first roundtable. And we at FDL were actually involved in having preliminary meeting with poor countries' Minister of Finance to define their position. This kind of things we do. We're also involved in the Macron-June conference. I don't know what to say about that. The president has very high ambitions, and it's not clear what are the instruments to deal with these ambitions at this stage. But this meeting comes after the spring meetings in DC. Spring meeting of IMF and World Bank is an important time of the year where all Ministers of Finance meet, take some decisions, and supposedly this year there were supposed to be decisions on the debt framework, but I think the discussion will be now taken over by who will succeed Mr. Malpass at the World Bank. I think I'm going to stop on that slide and take your questions.